Whoa! It's already happened! Look, right here, it's been one day, I've made 49p. Sadly, the medical bills are what I've just done to myself. It's completely offset this. Oh, God. Let's have a look. Oh, right, okay, so 20, 40, 50... Okay, so still £100 here. It hasn't made any money yet, but it hasn't lost any either. What's that doing here? Smells like profit. Oh hey there, it's been a good week. I've made money on the stock market. Now that I'm officially a successful finance bro, I thought I'd celebrate a little bit, splash the cash a little, you know? So I've got myself some premium whiskey here, not available for retail. I've got myself a brand new suit, and I've upgraded my setup. Well, I've tidied up a bit. Now maybe you're not like me and you do not have that inherent, innate ability with predicting the stock market. All of my predictions came true, and I'm 100% certain that is not something that is going to come back to bite me in the arse in the future. But since I've now made a definite profit in the stock market, it's time to take a step back and consider some of the dangers, the intricacies and potential pitfalls that can occur when trading. In preparation for this video, I've been on more than a dozen money management websites, spoken to traders with way more experience than me, and I've even invested in a book. The book that this book summarises is Benjamin Graham's The Intelligent Investor, and is in the backdrop of every single finance YouTube advice video. That being said, yep. Nice. Anyway, on to the dangers. I think it's best that we start off with one of two of life's absolute certainties: taxes. Section 1. Capital gains tax. I've got a full script here, so I'm going to be reading quite a lot from it to make sure I get all the information here correct. Bear with me, okay? Capital gains tax is the tax you pay on the profit you make when you sell an asset, like stocks, that's gone up in value since you bought it. In the UK, you pay 10% tax on any profit over the tax-free allowance, which is currently £3,000. The word currently is important here. Right, okay, let's say that you have bought £500 worth of shares and you sell them at £1,500. That's a tidy little £1,000 profit. You want some of this, Mr. Taxman? No, none for you, all for me. This is going on some top shelf whiskey. But let's say that you've had a roaring trading period and you've made £5,000. You'll have to pay tax on £2,000 of that, which works out to about £200, making your net take home £4,800. Not a huge hit, but it's important to remember that not all of this sweet, tasty profit is going to be yours. Maybe we'll settle on the second fanciest bottle of whiskey for our 5th round. Now you might be thinking, hey, 10% over £3,000 isn't too bad considering that UK employment tax starts at 20%. Well, prepare to feel a little cheated. It used to be better. About a year ago, as of recording this video, our gosh darn glorious government decided to slash that allowance down from £6,000. As if that wasn't enough. Prior to that, it was £12,300. £12,300 tax-free outside of your standard income. Bastards! Still, at least I'm using a commission-free trading website like Trading212 that doesn't take a dirty great cut every time that I make a trade, do they? Wait, what they do? Section 2. The spread. Well, it sounds like a great deal. No commission trading apps hide their fees in something called the spread. In short, they sell shares to you at a slightly higher price and they buy them back off of you for a slightly lower price than the market price. For smaller traders, the difference is relatively minor, but when you start investing larger amounts, that's when it really does cut into your profits. Think of it like a currency exchange at the airport. They have worse exchange rates than the actual exchange rate. I get it, they have to make their money somehow, so it's just as well that I started off small. Nonetheless, once again, bastards. Okay, look, are there any other chances out there who are going to try and take my money? Anyone? No? Right, good. Anyway now, how about Section 3, foreign exchange fees? Oh, come on! Foreign exchange or FX fees are surcharges levied by trading institutions when dealing with foreign currencies. A Brit buys shares of a US company, and they will have to pay an FX fee to buy shares of that company because the Great British Pound has to be converted to the almighty American dollar. And later back again. Is that it? Right. Anything else? Anybody else want to take a slice of my pie? This is actually quite a clever little finance joke that I made here. Stick around to find out why. Right, okay. Honestly, it's a wonder we can make any money at all these days. After all that, we haven't actually said anything about the stocks and their prices themselves. So let's see where that can go horribly wrong. Section 4. Timing the market versus time in the market. After sections 1 to 3 of this video, I need a bit of a pick-me-up, so I'm going to subtitle this section, Schrödinger's Stock Market. In trading and investing, you'll frequently hear the phrase, time in the market is better than timing the market. This fundamentally means that it's very difficult to predict with any real accuracy what any given stock is going to do in a short period of time. So you're better to invest and wait. For a real-life example, a good friend of mine who shall remain nameless, he recently invested in the stock market and almost immediately lost £1,000. It was, in his words, not a good first week. Sure enough though, some months later, the market bounced back and he made £1,000. But he did consider cutting his losses early on when the market first went down, which would have been catastrophic. Keep an eye on those air quotes floating around, they will be important shortly. This means it's generally better to leave your money invested until something good does maybe eventually happen than to make a knee-jerk reaction and move it to different stocks if you started getting worried because you tried to time the market and it didn't pan out right for you. Ultimately, as long as your money stays in the stock market, you haven't actually gained or lost anything until you sell. Until then, your stocks have the potential to fluctuate madly in either direction, and until then, giving you the opportunity to make money or to lose money. But nothing actually happens until you take it out of the market. Schrödinger's stock market. I'm really funny and also a nerd. Section 5, putting all your eggs in one basket. My fortunate friend also provided this incredibly eloquent insight into trading. Stock values go up and down like a hooker's knickers. No, I do not have B-roll for that analogy. With this in mind, it's worth noting that just because the stock market might be going up, it doesn't mean that all the individual company stock prices are going up. As such, a far safer bet might be to spread your investments across multiple companies, a larger portfolio, or, to give it the technical term, a pie. Remember earlier in this video when I made a joke and I told you it was a joke and I'd say why it was funny later? No, not the cat one, although that was pure gold. Yeah, the pie one, yeah, I told you it makes sense. Putting all of your money into one particular stock leaves you entirely beholden to that one stock. So if it does well, brilliant. If it does badly, uh-oh, too bad, so sad, never mind, all gone. Generally speaking, the stock market goes up with time. Kinda. But that doesn't mean that all of the constituent companies go up with time as well. These larger portfolios or pies are generally lower risk because they basically balance each other out and are more likely to increase over time, thereby ideally minimising potential losses. Similarly though, it can hold back any meteoric profits from individual companies. So there's a degree of give and take here. It can be very tempting to want to put all of your money into a single company, especially one that you feel strongly about or have an intense brand loyalty to. But unfortunately, finance doesn't really work well off of feelings. Alphabet based purely on the fact that they own YouTube, and I thought that might be a good move. And that leads nicely on to my final danger. Being emotional! Oh, calm down. Being emotional covers everything from panicking about the performance of your stocks to the much riskier choosing stocks not because of their security or current performance, but simply because it's a company you like. A company's likability does not necessarily mean they're destined to go up and up and up, although a company's unlikability can definitely send it down. Being overconfident in your choices without good financial reason is not a safe mindset when it comes to the trading world. This is probably not the most solid reasoning behind choosing any of these stocks. You need to do everything that you can in order to mitigate your risks and maximize your profits in this ever-changing, ever-chaotic world of business and investment. Don't rely on how a company makes you feel to determine whether or not they're going to be a good investment. Being overconfident in your choices without good financial reasoning is not a safe mindset in the trading world. All of my predictions came true, and I'm 100% certain there is not something that is going to come back to bite me in the arse in the future. Don't rely on how a company makes you feel to determine whether they're going to be a good investment or not. And for the love of God, do your research. It's been a week. Let's catch up on how my stocks are doing. Okay, starting off, £100. Yeah, day one, I managed to make a bit of money there. What? No, that can't be right. No, thank God. Right, okay. I was worried there for a second. What? No, don't do this. No, but that's why I put most of my money. Stop it! Stop it! Stop it! Stop it! No, stop it! No, stop going down! Stop! I think I need some help.